Headlines are coming fast. News alerts flash across your phone. Social feeds swirl with sensational claims about the new 2026 federal tax code. You see phrases like, "no tax on tips," "huge car loan deductions for everyone." They sound promising on the surface, designed to grab attention and hint at tax relief. But for high-income households earners, this noise is not just distracting, it is dangerous. Many widely publicized tax tips are, in fact, traps that do not apply to you, leading to false hope and poor decisions. This is not a time for guesswork. This guide cuts through the clutter. It provides a clear, actionable roadmap for the mass affluent, professionals, dual-income families, and small business owners who form the backbone of the economy, yet are targeted by complex rules. We will not waste time on gimmicks or small-dollar deductions that phase out before they help you. To understand federal taxes for 2026, start with one key number. For married couples filing jointly in 2026, that number is $403,550. This amount is a threshold within the tax brackets. If your taxable income, the amount after deductions, remains at or below this level, your highest marginal tax rate is 24%. If your taxable income exceeds the threshold, even by $1, that next dollar and all subsequent dollars are taxed at 32%. This change is a discrete bracket jump, not a gradual step. The jump from 24% to 32% is 8 percentage points and materially increases tax on additional income. For each $10,000 earned above $403,550, you will pay an additional $800 in federal taxes compared to staying in the 24% bracket. Effective planning does not aim to eliminate taxes, but to manage income so you remain on the favorable side of these thresholds when feasible. Many strategies for high earners seek to legally reduce taxable income to stay below this threshold. A year-end bonus or a realized investment gain may push you over the line, resulting in a higher tax on the additional income than expected. For years, deductions were straightforward because the standard deduction was high. That made itemizing uncommon for many households. In 2026, revisit the comparison. The standard deduction for a married couple filing jointly is $32,200. This is a straightforward reduction in taxable income, no itemization required. Compare your itemized deductions, mortgage interest, state and local taxes, charitable giving to that amount. If the total is lower, take the standard deduction. For many households, that remains the appropriate and simplest choice. For households in the $200,000 to $500,000 range, especially homeowners in high-tax states, itemizing may now be more favorable than the standard deduction. You have a choice. Take the standard deduction, or itemize when your combined total exceeds $32,200. If the total is $35,000, choosing to itemize gives you an additional $2,800 in deductions. For someone in the 24% bracket, that is approximately $672 of federal tax savings. Recent changes, especially to state and local tax rules, make it more likely to surpass this threshold. For 2026, the SALT cap is $40,400. Under the old rules, only $10,000 was deductible. Now $40,400 is deductible, an increase of $30,400. $16,500 state tax plus $12,000 property tax plus $20,000 mortgage interest equals $48,500 itemized deduction. Compared with the $32,200 standard deduction, that yields $16,300 more deductions. For a 24% bracket household, that reduces the federal tax bill by about $3,912. This is not a loophole, it is proper application of the new rules. If you are a homeowner in a moderate to high-tax state, review the new SALT cap first when evaluating deductions. Track deductible expenses more carefully than in recent years. While the new SALT cap helps, the 2026 code also features widely promoted deductions that deliver little value above $200,000 of income. Let us identify them early to prevent costly misallocation. Most carry strict income limits and phase-outs that act as traps for busy filers. Your task is to filter them out and focus on strategies that actually apply to your bracket. A prime example is the new car loan interest deduction. Its benefit begins to phase out at an adjusted gross income of $200,000. By $250,000 for married couples filing jointly, the deduction is fully gone. For most families earning $200,000 to $500,000, eligibility is unlikely. Practically speaking, that headline deduction is worthless. You will also hear about changes to overtime rules and exemptions. Some new protections simply do not apply above a $300,000 salary threshold. EV lease workarounds that once bypassed income caps have been tightened. Expect stricter enforcement. Assume credits are limited by income and model accordingly. Do not assume every EV purchase qualifies. Verify the specific model's rules and confirm your income falls within the eligible range. For any new break, ask 2 questions. What is the income limit? Where do the phase-outs begin? Headlines skip the fine print, and that fine print often voids the benefit for your bracket. Do not make major financial moves based on a headline alone. Prioritize durable, high-impact strategies not tied to low-income thresholds, such as maximizing retirement accounts, and leverage the newly expanded SALT deduction where eligible. Ignore the hype. Execute the math every time. Now, the tactical moves that actually improve your after-tax results. Step 1. Leverage the HSA for triple tax benefits. If you are enrolled in a qualifying high-deductible health plan, open and fund an HSA for unmatched tax advantages. For 2026, a family can contribute up to $8,750. This contribution is above the line. It lowers your AGI whether you itemize or not. Maxing out can save a 24% bracket family about $2,100 immediately. Inside the HSA, growth is entirely tax-free. Withdrawals are tax-free when used for qualified medical expenses. Unlike an FSA, HSA funds never expire. They roll over to build a medical reserve. This deduction can also help keep you below the $403,550 threshold. Step 2. Rethink cash yields and municipal bonds. With today's higher rates, cash interest can create unexpected tax liability. In the 24% bracket, $3,000 in interest adds $720 to your federal tax bill. Municipal bond interest is exempt from federal income tax and often state tax if the bonds are in state. Compare after-tax yields. 4.5 becomes about 3.15 after tax. 3.5 tax-free can be superior. The 3.8% NIIT may apply to taxable interest, but not to most muni interest. Keep emergency funds liquid. Consider high-quality muni funds for longer-term cash buckets. Step 3. Strategic shelters and the new child savings account. You may contribute up to $5,000 per child per year. The core benefit is shifting investment growth out of your high-tax environment into a more tax-advantaged space for your child. Use it as a supplemental tool after maxing core accounts, not as a primary retirement or college plan to reduce tax drag. Conclusion: your 2026 Action Checklist. The 2026 tax code is complex. You do not need to master every detail. Focus on a few high-impact choices for your income. Core numbers: $403,550, $32,200, and the new $40,400 SALT cap. Use these figures as your decision framework. 1. Audit itemized deductions. Some state and local taxes up to $40,400. Add mortgage interest and major charitable gifts. 2. Compare with the standard deduction, $32,200. If higher, plan to itemize. 3. Maximize your HSA, $8,750 for families, for triple tax benefits. 4. Review cash holdings. Compare after-tax savings yields to tax-free municipal bonds and reallocate long-term cash where appropriate. 5. Ignore headlines. Disregard deductions with low-income phase-outs, like car loan interest, if you do not qualify. 6. Consult a professional who knows your state rules, timing strategies, and bracket. You cannot tax plan away high income, but you can stop leaving money on the table. Review your state tax situation now.